Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter. Disruption in the wealth management space is accelerating at a seemingly faster rate every year. Joining me for this episode is Tim Welsh, who is the president of Nexus Strategy, one of the top consulting firms in the wealth management space. I first ran across Tim a couple months ago after reading one of his articles in Investment News. So I reached out to him, and I found him to have a really deep understanding of our industry, so I wanted to bring him on the podcast. Tim, thanks for coming on.
Thanks so much, Jay, for having me. Look forward to a fantastic conversation.
Yeah. Honestly, Tim, if we had just recorded our last conversation, it would have made for a fantastic episode into itself. So let's try and recreate it. We were talking about disruption, the winners and losers in the wealth management space, and how it's going to unfold. Tell me, what do you see?
Well, I kind of like to go back to the whole concept of what actually is disruption. In many industries, we've all seen quite a dramatic shift from the old world to the new world, driven by digital transformation. But ultimately, if you look at really what those companies did, it really was more of an unbundling of existing products and services and access and methodologies for gathering products and services. For example, if you think about iTunes and what they did with the hit single that you could get for 99 cents, you no longer had to buy the full album, which was mostly filler stuff. And you combine that with a media player on a mobile device, and that was literally the end of the music industry, and is now dominated by the digital players and streaming and so forth. So it was really a simple idea like that, just unbundling one aspect of what we used to take for granted, and that creates disruption. I'll give you another example. The classified ads in the newspaper. If you wanted to, look for a job or sell your car or do something, through the classified, you had to buy the whole newspaper. You had to go out there and get that. If all you wanted was just to look to see for those activities, a new job or a department or, selling your car or buy a car or whatever, you had to buy the whole newspaper. So what did Craigslist do? They literally unbundled the classifieds out of that vehicle, which was a paper format, and that was the end of the newspaper industry for many folks. Same for publishing. So those disruptions are very simple actions, but have dramatic results. And so in wealth management, if you apply that same kind of theory to what is happening, what the technologists are doing, and they're really trying to, again, unbundle typical products and services that financial advisors provide or the wealth industry provides. A great example is a separately managed account, the fee-based account. $5 trillion is in those accounts on Wall Street and in the broker-dealers of the world. And then along come the robo-advisors, and what do? They unbundled the money management fee and instead created an algorithm to replicate that. They use low-cost ETFs, so there's no longer any expensive trading, and use technology to rebalance frequently. And now you could take what was 200-300 basis points and drop it down to 20, 25 basis points. And in Schwab's case, it's free. So you're starting to see disruption happen really from what I call the great unbundling of wealth management. And there's many, many examples of that happening. And I think if we kind of look at the roots of how we've packaged in products and services together, this is really where the opportunities are. And another example for advisors, typically they bundle in a financial planning engagement with their assets under management fee at 1 or 2% or whatever it's going to be, depending on the assets of the client, which is fantastic, great full service model. However, what people are paying for, the advice, is really what they're being given away for free, which is the planning, and they're actually getting paid for on the assets, which we all know is being commoditized. So you're starting to see another unbundling even further of taking asset management fees and taking the planning advice component out of them, either through a subscription model or through retainers or fees, and then trying to find ways to replicate the asset management piece, which we know is being commoditized. So I think that's sort of the next layer of disruption will be that great unbundling of advice out of the AUM fee, and who knows who's going to win in that world. So that's the exciting aspect of keeping an eye on this space.
I love your analogy of the albums and looking for jobs in the newspaper. But what's funny, Tim? There's probably a third of the audience that never bought an album and never looked for a job in a newspaper. Isn't that amazing?
Oh, yeah, and that's just the sign of the times. And actually, I think what your point there really is how fast it's happened. This used to be the world order for hundreds of years, and now within a few years or half a decade, everything we've known to be true is now no longer the way people access services and products which is fundamentally at the heart of what we all do here in wealth management. So I think your point's well taken. And those examples, we'll try to think of other ones. Clearly, you could go to the Ubers of the world or the Lyfts and how they've unbundled the process of getting a cab from having to stand on a corner in New York City in the rain, watching 50 cabs zip by you to go to the garage where they're based in rush hour. Now you can sit in the bar, still finish your coffee or your beer, and get your car on your mobile app, and then it's right there waiting for you. So that we know is recent. And again, that whole idea of changing how investors, consumers access the stuff we take for granted, product services, that's really where disruption is going to happen. So it's going to be a very volatile time in our world, but also a great opportunity for advisors to jump on the forefront and unbundle themselves, if you will, before somebody else does it to them.
I love that. Before somebody else does it to them. Let's go deeper. Who are the winners going to be? What does it look like? And could you touch on subscription-based pricing for advisors?
Yes, I think the subscription model really is very innovative. We look to our good friends, Michael Kitces, Ellen Moore, who launched the AdvicePay platform, which is basically Venmo for financial planning. You know, how those are the only two guys on Wall Street who can take a credit card, if you think about it, because of custody issues. That ability to take the digital payment process. Now, advisors can work with the next generation of investors who don't have any assets. Right now, if people want to work with an advisor, I've got a $1 million minimum. Well, what if I don't have any assets? I've got a lot of income. I'm a new doctor, but I got $200,000 of student loan debt, and I got 2 mortgages, and I got 4 kids. I don't have any account for you to manage for me, but I could use a lot of help with that other stuff. About the refinancing or student planning, college funding, all those great things. You could charge advice for that, and now you have the ability to pay for it. So I think platforms like that are going to definitely change how people pay for advice. You don't need an AUM fee to do it. And when you do that type of work, you open up an entire segment of the population that can now access a financial advisor, because in the past, they couldn't pay for it because they didn't have assets under management or some sort of a product they could use to sell and buy, charge a commission. So I think that's one aspect of that subscription model that I think is going to be very disruptive. And it's also manifesting itself now. You know, again, back to our good friends here in San Francisco, Schwab, they're offering $30 a month to access a CFP on the phone with a financial plan for $300 to start, $30 a month. I don't think anybody can match that. That is a pure loss leader, unbundling of the AUM, the subscription fees, which we talked about, getting advice, you know, from a CFP. I mean, we're not talking just some 24-year-old on the phone at a call center in Austin, Texas. We're talking about a full-blown, experienced advisor on the phone or via video that has a CFP. That's pretty much what every advisor that we know offers, and now it's being unbundled into a $30 a month subscription fee. So I think that is what the whole industry needs to rethink, that there are ways to do that, to unbundle it, and think about charging differently for your prices. Now, for the winners and losers, clearly anyone who has a digital strategy first is going to win, because we know without a doubt that the internet waits for no one. It will come into our space, already has. Clearly, you know, stock trades used to be a couple $100. Now they're $5 because of the competition and the ability that you can just do it on your phone. The other aspect of the winners on the tech platforms, I think, are the savings modules, sort of the acorns of the world, where people can actually now work on their savings versus their investing. Investing is being commoditized. You know, the robos have crushed it, and the robos were then crushed by the big brands like Vanguard and Fidelity and Schwab. I think Fidelity's robo was just rated as the number 1 robo out there. So clearly that game is over, game, set, match. So where is the ability for digital transformation is going to be on the savings side. And you're starting to see these cash wars that are breaking out where platforms are offering, hey, you know what, we can't run the money anymore, but guess what? We can offer pretty cool rates on cash, which in this volatile times right now, people are starting to hoard cash. That's another area that I think, you know, if you talk to the venture capital folks, what they're investing in, they're going to the savings side. And again, these new platforms, they didn't go to the web, internet. They went right to the phone. I mean, they didn't even bother with a website. They said, we are an app on the phone, and that's how they're going to really transform the way people think about accessing these new tools. It's not going to be on a website anymore. I mean, you got to think mobile first. I know that's cliche, but clearly that's where it's all going, and is already starting to take roots. We're starting to see some really cool action there. The other winners are going to be, I think, the advisor technology software industry. They're the ones pioneering these new innovations. They're trying to, again, unbundle the TAMPs, firms like Orion or Black Diamond. They're really innovative. They're really coming up with new ways to build your own tech stack, unified integration, all those great things. I know that's a broader topic we talk about, but I think those 3 or 4 areas right there. And again, the good news is people still want an advisor. They want to talk to a human. People are funny about their money. So as the advisors think about this, how can you supercharge what you're doing through these new tech tools? And that's why I said the advisor tech industry is going to be a winner, because they're the ones who are investing heavily on this. You're seeing the custodians now open up APIs, bring the third-party vendors in, because they know that experience they can help clients deliver to their clients, advisors can deliver to their clients, is going to be the winning formula going forward.
All right, so let's unpack some of that, Tim. First, let's go back and start with AdvicePay. So I'm an AdvicePay user. It is as simple as Venmo, as you mentioned. Most of my audience are traditional advisors, either in the independent space or sitting at a wirehouse. Could you describe to the audience the application of AdvicePay?
Yeah, again, yes, it's really a way to pay for advice. And because of the custody rules out there, credit cards don't work, PayPal doesn't work, QuickBooks, if they find out that you're a financial advisor, they'll turn you off. So there's a lot of aspects of being able to pay with a credit card for advice that don't, because if the advisor has discretion over that credit card number to the charge, that's considered custody, and that triggers all sorts of really interesting regulatory problems for you to have custody of the client's account. And that's just determined because you can charge their credit card. You have free reign to do that. So you need a compliance layer in there. So that's what the software does. It allows for people to set up like a gym membership or Netflix, or however you want to think about, paying $200 a month or $300 a month for ongoing advice and guidance, or a one-time fee or a retainer model. Nobody wants to get an invoice. That's the worst thing in the world, as we know, because people typically bill on assets under management. You send your client an invoice and you say, hey, you owe me $10,000 for last quarter. Oh, I know I lost you 17% of your portfolio because the market went down. Now you get to pay me $10,000 for that privilege. Nobody likes that. So invoicing, paper, all that is really difficult, but people are comfortable doing it online. As we said, in the first iteration of the internet, people were sort of nervous about buying products online. Now people are comfortable doing that, and also services. They're more than happy to pay for services online, and that's really where this new model is. In fact, the next gen expects it. This is how they've grown up on these apps, and that's the power of that AdvicePay. And again, it allows the advisor to open up a whole new market, because now you can actually work with someone who does not have any assets. They're just getting started. That doctor I mentioned with the 3 mortgages, 5 kids, and high income, and student debt dragging them down, they don't have an account. They couldn't open an account with you. They can't work with you unless you work on a subscription model, and that is going to be quite a huge market that will open up. Because I think the big critique of our industry is that we only work with 10% of the people. That means 90% of Americans don't have access to an advisor simply because they don't have an account. And this opens up that 90%, which I think is very remarkable.
Yeah, so for listeners, the way the process works is fascinating. You go into your portal at AdvicePay, just like Venmo. You send a request for a one-time or reoccurring payment. They then put in their credit card information. You're never touching it. And then 7 days before a billing each month, they get notification. So it does create a billing situation, which makes old-fashioned advisors uncomfortable, but it actually creates an opportunity for the planner and the advisor to demonstrate their value on a regular, systematic way. And then, most importantly, in my opinion, service those smaller accounts to the level that they actually need. So that is a very disruptive tool in the industry. Do you see the wirehouses offering services like that in the future?
It's tough. And I can speak from experience because that's where I started on Wall Street. And the culture there really is embedded in product sales. And I know there's a lot of advisors out there who do a fantastic job, their CFPs and so forth, but the way they get paid, the way the system is built, the way the products are bundled, again, back to our theme about bundling and unbundling, that's their arsenal. So it's going to be very difficult to change that because, again, it's their product-centric world. They're Wall Street. That's what we do. We manufacture stuff, which is fantastic. We need that. But to go into a wirehouse and say, okay, I'm going to start charging my clients a fee just for advice, where's the production? How do I get that on the grid? How do I get paid? How do we monitor that? How do we oversee that? Their systems are just not there. So it would take a monumental shift. Not saying that they can't do it. I just think that it's just a challenging environment, and that's why we're seeing the growth really happen on the independent side, because these are the platforms that are available to people who are not sitting in a wirehouse. Now, clearly they have a fantastic array of technology, and they're really moving towards offering a much more holistic platform. But, in any sort of a closed system, it's tough to innovate. And when you're open architecture, full competition, wide open, advisors can shop the street for the best products at the lowest price. The independent space really is where it's moving. And we're not going to see this happen tomorrow or next year or 5 years, but maybe 10, 15, we're going to start to see those big institutions have to evolve towards this movement. And they most probably can. They're not going to let their bread and butter be, competed away just because they are slow to change. But, clearly as the industry moves, the demographics of advisors and the wealth earners change, that's going to be a big, powerful consideration. So lots to say about that, but I'll just pause there.
Yeah, I think there's an opportunity for forward-thinking, really, really competent planners to put out a pricing structure that is radically simple. I charge $1,000 a month for each one of my clients, whether you are a $1 million client or a $3 million client. And that type of pricing with its crystal clarity is going to differentiate them in the marketplace. But I got to tell you, Tim, I think we're a long ways away from that, from where we sit today.
Yes, it is. And it's just because of the nature of the beast. We all bill on AUM or some sort of a commissionable product. And that's great because the client really never sees it. They don't know what they're paying. That transparency that you're talking about will really alter the world. And I think it goes right back to our original theme. You're going to unbundle how these products are paid for and how the investments are happening. And if it's not going to be the industry doing it, the regulators will. They made a big attempt with the DOL fiduciary rule, and then clearly the babies of the DOL rule are coming back, or the states. So I think you're absolutely correct. This world will have to change, and people can get ahead of that, start it now, will stand like a bright, shining light for consumers because they're starting to ask those questions. The advertising from the industry, the discounters on the golf shows or the billboards, they're showing free, automated investment advice through a robot. That's free. That's tough to beat, free. And then same thing with ETFs. Vanguard's S&P 500 index is 4 basis points. I mean, that's literally as low as it can go. And you could probably argue that S&P ETF from Vanguard is probably way better than your separately managed account, which has underperformed for the last 10 years, and you paid 2 or 3% for that. The savings there are just dramatic.
Yep, definitely. So I want to unpack one other thing from earlier, and that is the whole cash wars theme and managing cash and the apps. Most of my advisors don't actually spend a lot of time thinking about that space. Tell them what they're missing and what they need to be paying attention to for the changes that are coming and that are going to have a really big impact on their business.
Yeah, fascinating. And I've been working on this for the last 20 years or so in my career based on various aspects and products that I've been working on in environments. Cash is always underlooked as a powerful asset. And again, we just talked about fees, 4 basis points. Well, literally in cash, there's like hundreds of basis points. Just look at the cash sweeps that the big brokers are doing where they're shoving the idle cash, which ends up being trillions of dollars, by the way, collectively, into the bank and paying, 0.004, interest on that stuff. Meanwhile, a money market rate's like 2% maybe, and you're starting to see that's a monster difference in terms of what you can get on your idle cash. And right now, the transparency, the unbundling, is starting to show itself with, Fidelity coming out offering a very compelling, hey, we're just going to sweep it into the money fund. We're not going to put it into the bank. Full page ads in Wall Street Journal showing we'll pay you 1.9%. Meanwhile, the others are paying 0.04, 0.003 or whatever it's going to be. And that's dramatic. And again, it's sort of an automatic thing. There's no transparency. People just assume I get paid on my cash because that's the way it used to be. But now because of the financial crisis of 2008, 2009, if you recall those money market funds, they were going to break the buck. And so all the brokers had to subsidize. They were losing hundreds of millions of dollars just subsidizing the money market funds. So what do? They all scramble to go find a bank and shove all that money in there. And that's done wonders. And then the Fed actually raised rates, and all of a sudden the brokers became extremely profitable. But now the rates are starting to come back down. The opportunistic folks are advertising against it. So if I'm an advisor, the value add, you can give your client another 1 or 2% on their cash. That's what you just charged them. So you basically gave them your fee right back to them just by optimizing their cash. And there's lots of products to do that. And just also being smart about the sweeps of the cash and where it's going, because you can always do a purchase, even if the brokers are sweeping you to the bank. You can still, but that's a manual thing and people forget about it. So I think that's an amazing development right now, the cash wars, particularly as investing fees and basis points just get squeezed and squeezed out. And we're down to 4 or 0 or free. It's going to be the next battleground, and so advisors have a great opportunity to add value to their clients and show your work. Tell them, hey, look, I know the market's a little choppy, whatever, but guess what we did over here? This, just on your money, I saved you X thousands of dollars. That pretty much paid for my fee, or whatever. Now you guys can go take that trip to Tahiti because we just saved you an aggregate $30,000 on your cash in the past 12 months. Very powerful messaging that advisors can use just by talking about money.
All right, so to sum this up, advisors, check out AdvicePay if it's a platform that you are allowed to have access to. Make sure you pay attention to the great unbundling that's happening in the technology space, and pay attention to your cash. Tim, where can listeners find out more information about you, your work, and Nexus Strategy?
Yeah, fantastic, Jay. Well, the company's Nexus Strategy, the website's nexus-strategy.com. We work with a lot of the vendors that support advisors in their activities and on the consulting basis, and we've had a fantastic run. Every year's been better than the last. The industry keeps growing, so very excited about that. If you're an advisor looking for marketing, we also work with FICOM Partners. They are a full-service marketing, branding, PR agency, and they work with some of the top advisors in the industry as well. So happy to support anyone. I also write a column for Investment Advisor Magazine and REA Biz. So if you're looking for some fun articles on these topics, do a search on those two platforms, and you'll find a few articles that we've written.
Excellent. Tim, thanks for coming on.
Hey, thank you, Jay, very much.